Good afternoon to everyone. So today topic is about auditing the inventory and warehouse cycle. So this cycle is quite interesting because it's interrelated with other cycle that we take, the revenue cycle and purchase cycle. So we will explain how related is this cycle in a short while. So the importance of auditing inventories. The reason number one is inventory is a major item in the financial position of the company. It carries a significant part of the working capital of the company. Also, the diversity of the inventory presents certain problems of valuation and observation. We have different type of items in the inventory. We have different value. So we have, let's say, if company dealing with let's say the computer part, spare part. So memory card is very expensive and very small, and we have other part, let's say the casing and the keyboard and so on is having different type of items and different type of value. Okay, the valuation of inventory is not straightforward because the valuation of the inventory in some items, it depends in the market. Like I mentioned, like let's say we have gold, where the value of the inventory is up and down according to the market, and it's not just according to the historical invoice that we have, the document that we have in the archive. Different methods for evaluating inventory, because we have LIFO and FIFO, we have another average method and so on. Also, part of the cost of goods sold computation, it involved in gross profit figures. So as you know, the gross profit, sales minus cost of goods sold, and the cost of goods sold is opening inventory plus purchase minus the closing inventory. So it involved in not only in the balance sheet statement as one of the current assets item, but also it's involved in the on the income statement or the comprehensive income statement under the cost of goods sold item. Okay, so this is the flow of inventory and cost. So if you see here, we have three types of what we call three types of inventory. One is raw materials, one is items in process or working process, and we also finished goods. So if you see the flow, so the flow of when we purchase them, we have this account. We will record the account here in raw materials. So we have any requisition from purchase cycle will be recorded in the debit side, and then we will credit when we transfer it to the working in process, and then when we finish, we will credit again in the process working in process and credit in the finished goods side. And then we will move it to cost of goods sold when we sell the item. Okay, so production cycle deals with requisition of raw materials for manufacturing and processing and transferring goods to finished goods. So inventory, as we said, is related to the purchase cycle and revenue cycle. Overview of the inventory cycle. First, it involves the production management departments. It has also keep the tracking of inventory used and needed in production. When inventory is needed, initiate the order by filling the purchase requisition, and this one will happen or will occur in the purchase cycle. Then in the inventory or warehouse department, we will have receiving the inventories and shipping the inventory. And if you notice, receiving inventory will be based on the purchase cycle, and shipping the inventory or delivering the items to the inventory to the customers is under the sales cycle. So it is like interrelated departments, and it happen under different accounting cycles. So auditors should bear in mind this kind of characteristics of the inventory and warehousing cycle. So also IT and accounting, keeping the record of purchase, sales, and inventory either in periodical or in perpetual system. Okay, so here is the documents and records. So here we have the production schedule is based on the expected demand, and normally it's based on the analysis of the purchase order. The sales order. Based on the sales order, we can get the expected demand. And normally, if we have software to handle the sales order and purchase order, it can bring us some indicators. So what is the expected items to be manufactured due to the frequent demand by the customers. Then we have the receiving report. Receiving report is a records of the receiving of goods from the suppliers. In some textbook or some company, they will use what we call RGN, or receiving goods notes. So it has the same features with the receiving report. Then we have material requisition. Material requisition is authorized release of raw materials from raw materials store. Then we have here we start the recording. We have the inventory master file, either updating, contains information related to the inventory. Cost of accounting, accumulation and variance report. So this one is cost accounting. We are recording what is the standard cost, what is the direct cost and indirect cost, and so on. So last one is inventory status report in terms of proportional inventory report or periodical. So tracking the type and quantity of the product on hand. So if you use now most of the companies, even small companies, they will intend to have the software which based on the proportional inventory, which is due to the real-time update of the items in the warehouse. Okay, so this is the functions in the cycle. First, we process the purchase order based on the flow of the inventory. So then what we will do, we will when we receive the raw materials, we will receive the raw materials. Then we put the material in the store and record. Then we process the goods. Process the goods means we are processing the goods in the production line, and then we back to the warehouse to store the finished goods. Then after that we ship these finished goods to the customers based on the customer order. Okay, so this is based on raw materials. This one is in the production cycle, and this one in the finished goods or the sales cycle. Another explanation, a major of the major functions. Here we are more to the details of the inventory. So number one is about managing the inventory in terms of the in and out, the flow of the inventory. So number two is raw materials store receives, and keeps the raw materials. Number 3 is about manufacturing department, the adequate of manufacturing controls over the physical flow of the goods and accumulation of cost attached to the inventory. Number 4, here we are dealing with finished goods, and then here we are trying to record according to the cost accounting, and here we are recording and ensuring that all inventories and cost of the production are properly recorded in the book. So we also here need to understand the segregation of duties between the different functions, those 5 functions. The one who set up the cost accounting, the standard accounting and so on, is not the one who recording the transactions, and is not the one who custody of the inventory, and is not the one who process the production, and is not the one who manage the inventory. Okay, so each function should be separate. Okay, so this one is kind of just explain what details should be in the material requisition, and it should also carry authorization by the production department's supervisor and manager, and it should update the proportional inventory for entry on job cost of sheets or cost center. Then we have the same thing. This is the production in sample way. Raw materials will be transformed through the production process to finished goods, and this one is involve labor, and labor usually we control it with weekly time card or daily time card, which count the time for the labors involved, and it includes the timing, the hours, how many hours they spend, and how many items they produce, which will help later on to allocate their labor's cost into the finished goods. And also the manufacturing overhead, also determining the overhead and allocated based on the units produced. Okay, so the summary of this will be transformed to the finished goods, will be reflected to the pricing strategy of the finished goods. So remember, we have the occurrence, completeness, and accuracy cutoff classification. This is the management assertions, and audit objectives will be based on this. And in occurrence, according recorded manufacturing transactions have actually occurred. So what they supposed to have? They supposed to have as a control for this to have pre-numbered and authorized material requisition, and to have production order, time cards, job cost sheet. For completeness, all transactions are recorded, to have pre-numbered of production documents and accounting for numerical sequence. For the occurrence, cutoff, and classifications, transactions are recorded. Transaction recorded at the proper amount in the proper accounting period and proper account classification. So what is supposed to have, what is presumed to have? One is independent internal verification of cost record with supporting documents. Overhead rate variance analysis should be reviewed and investigated in timely manner. Proportional inventory is implemented. Procedures and forms of manufacturing process should be processed. So here we have the part of the audit, And we will also see in the left side, we have the part of the audit, mean the audit, what the auditor can do related to the inventory, and it's we will link it to the cycle, the accounting cycles that we mentioned. So acquiring and recording for raw materials, labors, and overhead is normally it's done under the cycle of acquisition and payment related to the record of raw materials, whereby for the labor and overhead, it's under the payroll and personnel cycle, which we'll have it later on. Then number 2, internal transfer, assets and cost. This one is under the cycle of inventory and warehousing. Then shipment of goods and record revenue and cost. This one is under the cycle, under the sales and collection cycle or revenue cycle. And physical observation and inventory and price and compile inventory is under the inventory and warehousing cycle. So here we will see the interrelationship of various audit tests. So test of acquisition and payment cycle related to the raw materials and working in process. It is under the raw materials used and raw materials used. So this one will be under the acquisition and payment cycle. It is under the acquisition and payment cycle. It's not under the, so the auditor will not conduct it again in the inventory cycle. We'll just look into what the procedures that have been done in the acquisition and payment cycle and can use the findings. Then for working in process, direct labor, and working in process for indirect labor, we can use the test of payroll and personnel cycle. For the ending inventory for finished goods, ending inventory for raw materials, and working in process, we will have it under the inventory test of cycle. We will test of a cost of accounting record, test of physical inventory observation, test of pricing and completion, which will be our focus for this topic. So to understand, to conclude, working in process, which is cost of goods manufactured, it will transform to cost of goods manufactured under finished goods. And this one we can test the working in process or cost of goods under test of sales and collection, and it will drive to finished goods or cost of goods sold. What should the auditor be concerning about when the auditing of inventory cycle? So what the auditor should consider: number 1, inventory is existed or not. Whatever they report, is it existed? Because it's easy to, normally the company will try to manipulate the value, overestimate the value of the inventory to show that, to increase or to overestimate the current assets, to enhance the, what we call the manufacture or the working capital. Ensure there is no threat or risk of thiefiness of this inventory. To also the value of inventory, because we said that it's not straightforward valuation process. Also the related party transfers, because let's say the company have branches, mother company and branches company, so they can transfer this the value of the inventory from one company to another to mislead the auditor. Okay, so possible errors and misstatement. 1 is inventory cost can be manipulated. Number 2, unauthorized shipment. 3, thiefiness of the goods in the inventory. 4 is overestimate the inventory amount. Why they do it? to manipulate their reporting earning, because inventory and the other account related to the inventory, which is the sales revenue, is related to the inventory. So the more they sell, the more the inventory will be changed. So normally when they manipulate the sales revenue overestimated, they will also manipulate the inventory. Okay, so it need to auditors should consider this. So now let's move to say the inventory inherent risk assessment. Number one, industry related factors, because based on the demand and the price of the inventory may affected by the industry price. And the simple example for this is the medical stuffs or the mask during the pandemic, the COVID-19. The demand is increased and the price is high. So in that case, the people will demand a lot. So the company may need to increase the evaluation of the inventory. And the opposite is correct, or the vice versa is right. Let's say we have during the pandemic or during the COVID-19, we have less shopping. People are not going to do shopping, or less going to, let's say, travel. So the stuff like bags, let's say if you have a traveling bag or stuff for clothes for cold weather, is less demand and the price will drop down. So the inherent risk that the company keep the same price in the record, whereby they cannot sell it with the same price again. Number two is the nature of inventory. As I said, small items but high value, more susceptible to the theft. And I give you example of the memory card. Then another point, another inherent risk is the difficult to audit account due to the method of evaluation and estimation of provision and absoluteness. Absoluteness means the what we call the old style. So I give you example of let's say the one company, they are selling CD, the CD-ROM. They are selling videos, original copy of movie. So in this year, they will price their inventory with each item is, let's say, 50 ringgit. But after, let's say this movie is 2007, 2010, let's say. So now I believe the market price for this is considered 1 ringgit. So it's old style or old items cannot be evaluated with the same price like 10 years ago. So this is the issue of absoluteness. Okay, then we have the involved related parties transaction, as I mentioned just now about the mother company and branches or other sort of related parties. Last one is period misstatement beginning of inventory. So if there is a misstatement of the last year inventory, then it will carry to the this year, because the last year ending balance is the current year inventory balance. So now let's move to the designing and performing audit test of cost accounting. So cost accounting controls, we have two main phases. First is, or two main types. First is physical control over the raw materials, work in process, and finished goods of inventory. So we need to see the physical controls over the three types of inventory, whether it is raw materials or working in process and finished goods of inventory. So what we mean by physical controls, we means the CCTV, the security, the temperature control, and especially if we deal with chemical and so on. And then control over related cost. So we try to reduce how they control related cost by reducing this cost in terms of segregation of duties, in terms of having less cost for these items. So test of cost accounting, we have, as we mentioned just now, we have physical control over inventory. Number two is documents and record for transaction inventory. Then using a proportional inventory master file is also controlling. And last one is unit cost record. Unit cost record, okay? So all of this four tests is, or for this four area that should be tested related to the cost accounting. Then we see here the method, same diagram we have for the from the previous topics, either purchase or revenue cycle, and we have the same diagram here, understanding the internal control for cost accounting system. Number two, assessing planned control risk for cost accounting system, determine the extent of test of control. Then we run the design, or we form and design test of controls and substantive test of transaction for the cost accounting systems to meet the transaction related audit objective. And this design should involve the four criteria: audit procedures, sample size, item to select, and timing. And here is the example of substantive test of audit procedures, or what we call the audit program of substantive test of manufacturing transactions. And we have number one is select sample of entries in proportional inventory record. We try either to watch to receiving report or watch to shipment of document. Number two is select sample of receiving report. Select a sample of receiving report and treat them to entries on proportional inventory record. And select, number three is select sample of shipment of orders and treat to entries in the proportional inventory record. And number four is to ask about inventory related inventory located off premises if they have. Meaning that if we record, we ask if they have items of inventory in the out of campus, maybe located in different inventory or third party or agent for a warehouse. Number five is trace cost record to supporting bills of materials, time cards, authorized labors, rates, and standard overhead rates, and review variance report. In number five, normally we do it in based on the sampling, okay? So now also we are still within the standard, auditing the standard cost. So we need first to see two criteria. One, the standard cost should approximately actual cost, should be up to the actual cost. So what we will do, we will review. As an auditor, we will review the policies and procedures for constructing standard cost. Number two is to test, we will test the component of cost build up for the sample of standard product cost. The next area that we will test here is to check the component of the product cost. Example is materials, labor, and overhead cost, which is the three components of the product cost. Then we will start to do some tests, either trace for material, raw materials, we will trace to suppliers invoice or standard cost card. For labors we will also trace for labor and rating hour. We check whether it's equal to wages schedule. Last one is about overhead. We will review the methods of allocation of overhead costs. We try to see whether it's consistent from last year or there is a differences. Then we move to audit the beginning inventory of first time engagement. In case we have first time engagement, then we need to consider the following steps. Number one is we need to test whether the opening balance do not contain misstatement that materially affect the current period of financial statement. Number two, we need to check the periods of closing balance have been correctly brought forward to the current period when the appropriate and have been restated. So we need to check the accuracy and accuracy of the total amount and the materiality of any misstatement have. Last one is we check the appropriate accounting policies are consistently applied or changes in the accounting policies have been properly accounted for the adequately presented and disclosed. So number one is about the balances, the opening balances. Number two is about the checking any balances brought up from the previous year. Number three is we are trying to check the accounting policies consistency. Is it consistent with the previous year or not, previous accounting period or not? Okay, so here we have a list of analytical procedures related to the inventory and warehousing cycle. I will not read it in details. I will tell, maybe we explain the first two and the rest you can read in your own. So number one is compare gross margin percentage with the previous year. So we are trying to check the gross margin for this year with the previous year. What is the possible misstatement here is whether maybe there is an overstatement or understatement of inventory and cost of goods sold. So especially if we have, let's say for the last 4 years or 5 years, we have somehow consistent amount of gross margin, whereby for this year we have very high or very low. So in that case, we will consider overestimate or underestimate of cost of goods sold. Remember, cost of goods sold is related to the inventory, and it is also will affect directly the revenue. So in case we have underestimate the cost of goods sold, so it means they are trying, or this company trying to increase the profit margin, and as well as they will increase the revenue value. Okay, number two is compare the inventory turnover in terms of cost of goods sold divided by average of inventory. With that, with the previous year. So we compare that turnover of the inventory. So we check the movement of the inventory from last year and this year. We compare either it's high, over, or below, low. So what we get here, what is the possible misstatement here is absolute inventory overstatement or understatement of inventory, and so on. Okay, so we move now to the methodology of designing test of balance of inventory. Just now we do the design of test of control and test of details of balance, which is in phase 1 and phase 2. So we will discuss this. So remember, we discuss identify the client business risk affecting inventory, set up the trouble statement, and assess the inherent risk in the inventory, assess the control risk, for several cycles. Why we say several cycles? Because the inventory is related to different cycles, related to the purchase cycle and sales cycle. Okay, and also we can say also payroll cycle, payroll cycle, which is related to the cost accounting and labor. Okay, and then in phase 2 we design and perform test of controls and substantive test of transaction for several cycles also. And phase 3 we design and perform analytical procedures for inventory, which we discussed in the previous slide. And lastly, phase 4 we design and test the details of inventory to satisfy the balance related audit objectives. And we should involve in our designing the 3 criteria: the audit procedure, sample size, and item to select, and the time to run that test or procedures. Okay, so let's say the balance related audit objective. Number 1 is existing, 2 completeness, 3 accuracy, and 4 is classifications. And we also have cut off, realizable value, and rights. So I believe we have we understand what does it mean existing in the level of balance and related audit objectives. So existing is the inventory as recorded on tax and on tax exist, and completeness, existing inventory is counted and tagged. And we say, why we say tagged here, because we assume that the company have the tag system or the barcode system, so they record it accordingly. So using the tag number. So accuracy, the inventory is counted correctly. Classification, inventory is classified correctly on tax. And then cut-off transactions are recorded in the proper accounting period. And realizable value, obsolete and unusable inventory items are excluded or noted. Okay, the last one is rights. The client has right in inventory record on tax. Okay. So that's what the management assert. So what to do, what the auditor should do. So for occurrence or existing, additions to inventory records are voiced to receiving report. Why we say additions means any additions to the opening account balance for the beginning year, and then any additions we try to do watching to the receiving report, because we will not do watching to the previous year. Okay, so number 2 is issues voiced to shipment documents. And for completeness, we will select sample of receiving report and trace it to proportional inventory record. Number 2 is select sample of shipment order and trace it to inventory record. Then we have accuracy, cutoff, and classifications. We do the inventory summary of sheets, verify the quantities, price, existence, and footings. And this one is under the accuracy, whereby for cutoff, quantities traced proportional inventory record, we check whether it's recorded in the right time in terms of the date. And then last one is review standard cost to check the classifications of account. Okay, now we move to next topic, which is designing and perform physical observation and audit of test of for inventory. So normally the normal practice we have the company, one of the internal control that the company, each company should have physical examination or physical count for the inventory. They do it once a year to check to reconcile the physical existing of the items according to the proportional system of inventory record. So we have two types. If you remember, we discussed this: the proportional and periodic inventory. And normally we have nowadays it's most of the companies will use proportional items. So for the periodical inventory, if it is existed, it's the quantities on hand determined by physical count on or near to be to the financial statement date. So they wait until the financial statement or the balance sheet time. So what they will do, they will try to quantify and try to do the physical count for the inventory. Whereby for the proportional inventory, which we said is more effective and more real time, the record are maintained documenting all items on hand, raw materials issued and finished goods sold. Both are updated based on real time, and then the physical count will depend on the existing of the effective internal control structure. So auditor will rely on the internal control more in the proportional inventory, whereby for the periodical inventory, auditor will count more into the physical count process. So physical observation test, the most important part of the observation of the inventory is determine whether the physical count is being taken in accordance with the client instruction. So auditor, what the auditor do here is trying to see whether they do it according to the instruction of the or the policies of physical count of the inventory. So what is the instruction of physical count process? Number one is they should have proper instruction for physical count. The company should have proper written instruction. What is the policies, what they should do, and who should do it, and it should also include who's the supervision and what is his or her responsibility, and then also they should ensure the independent internal verification of the count. So they should establish in this instruction independent verification from group to another. The one who count shouldn't be the one who record, and should be another group to verify what the two first process and so on. Last one, the point before the last, independent reconciliation of the physical count with the proportional inventory master file. So they should have this also in the instruction. Last one, adequate control over the count sheets or tags. So they should have proper documentations and controls to who's supposed to authorize those documentations of physical counting and who's supposed to hold it and so on. Okay, so according to the ICE 501 related to the stock take observation, they list five points related to the physical observation. One is obtain audit evidence on validity, ownership, cut-off, valuation, and of inventory. Number two, make proper preparation before going for inventory physical counts, and we will discuss what is the proper preparation for the inventory physical counts. And three is inspect the inventory, observe compliance to the management accounting procedures, check for obsolete stocks. And we define just now the obsolete mean the stock that already out of date or old stock that will not valuable, will not carry the same value like previous year. Note not to absorb all inventory, but only when it's material to the financial statement. So let's say some items like screen protector or covers, they are, especially if they have minimum quantity and they have less amount of uh, in terms of value, they have less value compared to, let's say, the memory card. So auditors should focus in the what is focus in their observation for the items that carrying material value to the financial statement. Last point is perform test of count, record the sample in working paper of the audit process. Okay, what is the preparation before attending the stock count we mentioned just now? First one is call. We need to call the client and confirm the date, time, and place of the physical count process. Number two is request. We need to request the company stock count instruction. So we need to know what is the instruction, who's the person in charge, how many people, how many staff will be involved, and we need to know the independent verification process and instruction. So we need to read and study before we go. And number three is reading the last year working papers and check whether there were any issue that rose during the stock counts. And then number four is having the equipment, the necessary equipment, either calculator, papers, pens. You cannot just keep asking them to us to borrow during the observation. So do you have what you need for the stock counts? That is the question. Okay, so here is the audit steps for observation of physical inventory. Before the observation, first we need to know, as we said, who will perform the inventory count. And number two, we need to know on what date and what time will the count be taken. So this one just mentioned. Number three is where will be the physical inventory, so we know the place. So also how will inventory items be arranged? We need to know the layout of the inventory or the warehouse, how they will arrange their process. So I need to see whether, as an auditor, I need to see the process line and how they will conduct and avoid the double counting. Also, to check whether they have pre-numbered account tag or sheets to be used. If yes, then it's good control. If not, then I should consider the inspect of the validate those documents and validate the documents of recording. Okay. Also, how will inventory movement be controlled? Last one, how will inventory at other locations outside the client premises be determined? And how will obsolete and slow moving items be identified? So, and I believe as an auditor, we'll focus on this in those items or try to see how they will handle the obsolete and slow movement items, and maybe get some inquiries from the warehouse staff related to that. Okay, so finish before, let's say during the observation. Number one is the auditor observe the inventory count teams to ensure that they understand the inventory instruction, the inventory counting instruction, and that they are carrying out the inventory count diligently and completely. And then B is the auditor identify the damages, obsolete or slow moving items. So one way to do this is to ask relevant personnel As I said just now, we check with the warehouse team and then see the audit test control over the inventory movement during the count. D is the auditor make test counts and check the quantities agree with the count sheets or the count tags. So we try to select some samples and check what they record in the count tag or the count sheets with the physical existing of some items. So this is example of count sheets and count tag. So then we have after observation. After observation, auditors should do data to check the data from inventory tags are recorded on inventory summary sheets, and also auditors should examine and verify the inventory summary sheets. Also, auditor should compare the test count findings with the final inventory sheets. Lastly, finally, auditor should issue narrative memorandum describing the inventory observation process. So if he found something not acceptable, bring in questions, so he should write a description for that. Will help later on to put it in the working papers for the auditing as a supporting for any decision about the inventory. Okay, so the last topic under this chapter is designing and performing audit tests of pricing and completion of inventory. So remember, the audit pricing and completion for the inventory pricing test, we need to understand that it's based on, as we said, it's based on the market, it's based on the value, and there are different strategy for pricing, either based on the cost or based on the market price or based on the cost of production, as I said. Okay, so pricing and completion controls should be tested, and pricing and completion procedures, and the last one is valuation of inventory. Balance related objectives, inventory and pricing and completion. We need to test details tie-in, existing, completeness, occurrence, accuracy, classification, realizable value, and rights. So we valuation of inventory, as I said, it's based on either the pricing of purchase inventory, which is the cost, or the pricing of manufacturing inventory, also related to the cost. If we purchase, number one is pricing purchase inventory is for merchandise companies, but for the pricing manufacturing inventory is the cost of product producing units. So it is based on accounting, cost accounting. Last one is about the strategy of pricing, whether it's based on cost or based on the market. Because remember, like iPhone, the cost is not more than $100 US, but the price is more than 1,000, especially the new model. So it means that they follow the valuation of inventory is based on market. Okay, so last point is how e-commerce affecting the inventory management. We need to know that now everything is computerized, and the system managing the inventory system is now we have several software that help to ensure the efficiency of recording and even controlling the items. Now even what we call with Amazon, they are one of the model. They are using the drones to observe, count the inventory movement, and so on. So so the internet enable companies to provide complete descriptions of their inventory on real-time base. Also, the use of the internet or the software application may lead to financial reporting risk if access to inventory database and system is not adequately controlled, especially if the system is not referred or is not from referred vendors. Okay,